Hello traders, welcome to Knowledge Candles. Today is Sunday the 27th of October 2013 and this is Jaidev Sharma presenting you the second of a two-part video on how to use trends and trend lines in your trading. In part one, we looked at how do you technically define a trend on a price chart. How do you basically identify whether the price is in a upward or a downward trend or it is moving sideways, and then if you see a trend, how do you correctly draw trend lines. In today's video we will look at how to use trends and trend lines to make your trading decisions. You can use them to formulate your trading strategies on its own, or you can use them as an additional aid to alongside other tools. Okay, so we'll be looking at three different ways of using trend lines for trading. And the first one is trading with the trend. And now, in order to make the most profit in trading alongside a trend, you've got to join the trend at fairly early stage of its formation, so that you can ride it till it breaks down. And the second is when you notice the price trend, it has already traveled quite a distance. So rather than joining with the trend, you wait till it breaks down and then you go against the trend. Okay. The third is a combination. And when I say combination, what it means is that you basically look at two different time frames, one larger time frame and one smaller time frame. So let's say an hourly time frame and a 5-minute or 15-minute time frame. Now if the price is trending in one direction on hourly, then you look for trends in the same direction on a smaller time frame as well. Okay, so if it is trending upward in an hourly, then you look for upward trend on 5 or 15 minutes and then fade the trend on the smaller time frame to join it to join the trend on the bigger time frame. So it's a combination of the two strategies. Anyway, we will look at these with some illustrations of price charts. Let me draw my drawing tool. Okay, so on this chart I've just drawn a very symmetric upward trend, and this is just for illustration. I'm using only upward trends, but the principles are applicable even for downward trends, and you can use the strategy that I talk about for down trends as well. Okay, now on this chart, as you see, when the price starts making this move from here, it prints a high and then comes back and prints a low, which is higher than this low. So it prints a higher low. Now the moment it does that, you've got to be looking for the trend formation. Okay, by technical definition of a trend, the moment you've got two pairs of higher highs and higher lows, it is in trend. Okay, so you are looking at this point here where it previously printed a high here. So at the time it breaks through this high, technically the price is in a rising trend. Therefore, in order to join this trend, I would recommend taking a long position at the break of this point. Okay, so you take a long position here with the protective stop just below the previous low. Okay, now if the price, because the price is broken, obviously it will print a new high. That means it is already in a trend. Now if after printing this high it comes back and breaks the previous low, you will get stopped out, so you make a loss. No problems, look for new trade. However, if it continues to follow the trend, which is it has just started forming here, then in all probability it will go and break this high as well. Okay, yeah, so the moment price break this high, you move your stop from the initial stop position, which was here, to this new, just under the new higher low. Okay, so you are trailing your stop loss to the new higher low. Okay, and you keep doing that as long as price keeps making new higher highs and higher lows. Okay, so when price breaks through this, you move the stop here. When the price breaks this position, you move the stop here, and so on, so on. Eventually there will come a point when the price no longer continues the trend and it breaks not only the trend line but also a previous higher low. Okay, so now by this time you would have moved your stop loss here. Okay, so when this happens, you will be stopped out. Okay, you will be stopped out automatically because you would have moved your stop loss here, but by that time you would have booked a profit of, so this was your entry. Yeah, you would have booked this much profit, and if you see your initial stop was this much, so there's a substantial profit to be made. Now you're able to do that because you joined the trend at its very infancy. Now there is always a chance that having just looked at two pairs of higher highs and higher lows, and the trend may actually not form at all, so you'll make a loss, but that's life in trading. Okay, so this is our first strategy. As I said, I have demonstrated only a rising trend, but the concept is applicable for a declining trend as well. Okay, we'll now look at the second approach or second strategy, which is fading the trend. So okay, for that, let me just pull up another picture. Now suppose you when you look at a chart and it is already in a trend and it has traveled a fair distance and you have not been able to join at an early stage, then my recommendation will be not to jump in the trade in the middle of a trend. However, wait for it till a point that it breaks the trend. Okay, so so in this particular case, let's say the price is making a trend like that and you spotted it somewhere here. So my suggestion will be to wait till it breaks your trend line. Okay, so till it breaks your trend line and also the previous higher low. Okay, so when it does that here, you enter a short position. Okay, so your entry will be through a sell stop just below this, and your initial stop loss will be above this, above the previous high. Okay, now if the price goes back and takes the previous high, then you would have lost the money and you'll be stopped out. However, having broken this trend, there is a likelihood that the price will actually start going down in waves like this. Okay, so your initial short entry was here with the protective stop here. Now when price breaks the previous low, which is the low here, when it breaks the low here, at that point you move your stop loss just above this. Okay, so you're moving your stop loss here, and it goes like this and again here. So when it breaks this position, you move your stop just above this. Okay, and you ride the trend like that. Okay, so it is just the opposite of what we have seen in the previous chart, but you're joining you're taking a trade when the trend has exhausted. Okay, at the break of the trend in the opposite direction, by taking an entry in the opposite direction at the break of previous high low, stop loss just above the recent most high, and then trailing the stop loss as the price starts making a structure downward. Okay, so this is called fading the trend strategy. Okay, now finally let's look at the combination of these two strategies. Okay, so for that, let me just take a bring out another picture. Okay, so as I said, in this particular strategy, we are looking at two different time frames. So let's say this is an hourly time frame, and the price is making an uptrend on hourly. Okay, so this is hourly. okay, and it's making an uptrend. Okay, now typically what happens when you look at a price chart, due to the fractal nature of price movements, when you look at smaller time frames, in all probability the price will be making waves like that. Okay, so the idea of this strategy is to look for a trend in a smaller time frame which is in the same direction as the larger time frame trend, okay, and then wait till that breaks down, and then you basically take a position opposite the shorter time frame. Okay, exactly the way we discussed in the previous picture. So enter short here and stop loss above this. But in this particular case, you ride the price only up to the point that it touches your trend line. Okay, so you're not risking the break of this trend line because this is a higher time frame trend line and it is hard to break. Okay, so in this particular case, sometimes the risk to reward could be very small, therefore you've got to be more careful. However, this strategy supports the very nature of price movements, which is reversion to the mean. So when price goes steeply like that on a shorter time frame, in all likelihood it will come back to visit the mean, which is the larger time frame trend line. Therefore it is quite a safe trade, but as I said, the risk to reward can be small, and therefore you have to just see how much reward there is for the risk you're taking, and if it doesn't stack up, then don't take the trade. Okay, so we've discussed three different strategies for trend lines. First one, riding the trend. You try and join the trend in its infancy. Second is fading the trend, which is you wait till the trend breaks down and then take a trade in the opposite direction of that trend and try and ride trend in the opposite direction. And the third one is a combination of the two, in which you look at two different time frames, example hourly and 5 minutes or 15 minutes, or daily and 15 minutes, and so on and so forth. Okay, so with this I conclude my videos on how to use trend lines for trading, and hope it is useful. Until next time, goodbye and God bless you.